For decades, First Brands stood as a pillar of the auto parts industry, a name recognized in households and garages across the country. The company supplied essential components for millions of vehicles, from family sedans to heavy-duty trucks, and provided stable employment for thousands of workers. Its sprawling factories and bustling warehouses were symbols of American manufacturing might, and its logo was a familiar sight in auto parts stores nationwide. For years, First Brands seemed unstoppable, expanding into new markets, acquiring competitors, and posting record profits. But in September 2025, the unthinkable happened. The company abruptly filed for bankruptcy protection, sending shockwaves through the industry and leaving customers and investors stunned. The collapse didn't just rattle the auto industry. On Wall Street, banks and lenders who had backed First Brands faced enormous losses, and the company's sudden downfall triggered a wave of uncertainty in financial markets. Investors scrambled to assess the damage, while analysts tried to make sense of how such a trusted giant could fall so quickly. Suddenly, the stability of a company that many had relied on for years was in question. Employees worried about their jobs and livelihoods, while consumers wondered if they'd still be able to find the parts they needed to keep their vehicles running. The sense of security that First Brands once provided was replaced by anxiety and doubt. The bankruptcy exposed the hidden dangers of unchecked growth and heavy borrowing. As the company's financial troubles came to light, it became clear that rapid expansion had come at a steep cost, raising alarms throughout the financial system and prompting calls for greater oversight. Now, as investigators dig into the company's records, they're uncovering a complex story of aggressive expansion, fueled by mounting debt. Each new document reveals more about the risks First Brands took in its quest for dominance, and the warning signs that were missed along the way. The fall of First Brands is more than just a corporate failure. It's a cautionary tale for the entire business world. Its story is already prompting companies and lenders to rethink their approach to growth, risk, and financial responsibility, hoping to avoid a similar fate in the future. First Brands made the parts that keep cars running: oil filters, spark plugs, water pumps, sold everywhere from AutoZone to Walmart. Its products were trusted by mechanics and DIYers alike, making the company a fixture in American garages. The acquisition of iconic brands like Autolite cemented its reputation as a go-to source for essential auto parts. The business model seemed solid: make necessary products, sell them everywhere, and enjoy steady demand. But beneath this stability, the real problems were financial, not mechanical. First Brands didn't just grow, it exploded onto the business scene, making waves in the industry almost overnight. The company's ambition was clear from the start: to become a dominant force, not by slow and steady progress, but by bold, decisive action. In just a single decade, First Brands bought up about 15 competitors, each acquisition adding new products, talent, and market share to its growing empire. This aggressive approach set it apart from rivals who were still playing catch-up. This roll-up strategy, snapping up established, trusted brands, let First Brands quickly dominate the market. With every deal, its reach expanded, and its influence grew, transforming the company into a household name almost overnight. Wall Street cheered each new deal, seeing efficiency and profit in consolidation. Investors were thrilled by the promise of bigger returns, and the company's stock soared as confidence in its leadership grew. The company's leaders were praised for their bold vision and daring moves. Each acquisition was seen as a masterstroke, a sign of fearless leadership. But behind the applause, every deal came with a hefty price tag and new risks. Soon, the business became as much about making deals as making auto parts. Negotiations, mergers, and financial maneuvers became part of daily life, shifting the company's focus from its original roots. Behind the scenes, the need for constant capital drove First Brands to borrow more and more. Loans and complex financial arrangements piled up, fueling the company's rapid expansion, but also increasing its vulnerability. The company's rapid expansion looked impressive on paper: factories, offices, and new markets opening at breakneck speed. But eventually, the mounting costs and growing debt began to catch up, casting a shadow over its success. The relentless pace left little room for error. As pressure mounted, even small missteps could have big consequences, and the empire that once seemed unstoppable now faced new and daunting challenges. To fund its aggressive buying spree and rapid expansion, First Brands borrowed billions from Wall Street, tapping into a vast network of financial institutions eager to lend. The company's appetite for growth seemed insatiable, and it was willing to take on enormous financial obligations to fuel its ambitions. It wasn't just the big banks. Private credit firms also lined up to provide capital, drawn by the promise of lucrative returns. As a result, First Brands became heavily leveraged, with its mountain of debt far outpacing the profits it was actually bringing in. These weren't simple, straightforward loans. They were complex, high-risk financial deals, often involving intricate terms and conditions that demanded a steady, robust cash flow just to keep up with the interest payments. As long as the company kept growing at a breakneck pace, it could manage the payments and keep the lenders satisfied. The strategy worked, until it didn't. But the pressure to maintain that growth was immense. Every quarter brought new expectations, and any misstep, no matter how small, threatened to unravel the entire operation, putting the company at risk of default. Lenders, enticed by the prospect of high returns, often overlooked the mounting risks and the company's increasingly fragile financial position. The warning signs were there, but optimism clouded judgment. When business faltered and revenues dipped, the debt that once seemed manageable quickly became a crushing burden, threatening the company's very survival. In the end, the very loans that had fueled First Brands' meteoric rise ultimately led to its dramatic downfall, serving as a cautionary tale about the dangers of unchecked debt and relentless expansion. First Brands' bankruptcy is a wake-up call for Wall Street and the private credit market. Lenders now face huge losses, and questions are swirling about the company's accounting practices. In the opaque world of private lending, red flags can go unnoticed until it's too late. The collapse exposes the dangers of excessive debt and unchecked ambition. It's a reminder that real business health, not just financial engineering, matters most. When growth is built on shaky ground, the fallout can be severe for everyone involved. Even the biggest empires can crumble if the foundation isn't solid.